Swayam Prabha. Digital India. Educated India.
Hello and welcome. So, we will continue our discussion from the previous session. We started a firm, a stationery shop in a room of a hostel, and we are trying to build the balance sheet, profit loss account and cash flow statement. Through that, we are going to demonstrate the meaning of these statements and how they are prepared, how they evolve, and then how we actually make them. So, we have seen that the student, they say you are the student and you have procured the minimum required infrastructure, like say furniture fixture of a rack, a counter, and then eventually you during the year after you have seen that you cannot really cope up with the demand, you need an additional hand. So, you have recruited a guy at the salary of 5,000 rupees a month, and for him you have bought a chair and a billing machine, because without a billing machine you cannot keep track of the transactions that are happening. So, with that we have all these other data that is representative of the operating performance of your company. Say you have made a sales of 5 lakh rupees, then you have purchased total raw material of 2,50,000 rupees. All these are data pertaining to different aspects of the business. Say for example, all these aspects are captured in different ledgers called general ledger. So, you have a general ledger by the name sales. So, whenever you make some sales, this is entered into the sales registered. Suppose some sales is returned back, somebody returns you some good which is damaged or defective. So, you reduce the sales. At the same time, when you make fresh sales, you increase the sales. Similarly, whenever you make purchase, you enter into the purchase ledger, other than entering into cash ledger or accounts payable ledgers, you also enter into purchase ledger. That is how purchase ledger keeps on growing, and then at the end of the year you want to see what is the total purchase that you have made. Similarly, the salary ledger will show you what is the total salary paid during the year. Similarly, rent, closing stock is the stock that remains at the end of the business. On 31st March 2019, you looked into your shop, and whatever you can see, you took a stock of the inventory and you added them up, and you found that total inventory as on 31st as at the close of business on 31st March is 10,000 rupees. So, that is a balance sheet item, that is not a profit loss account item. Coming to that. So, for transportation you have spent 5,000 rupees, telephone 3,000, electricity consumption of 6,000 rupees. These are all annual cost. So, this data is some kind of general ledger balances, and many of them are expenses and many of them are balance sheet item. Balance sheet items are those which is kind of a closing balance that goes into the balance sheet. So, for example, closing stock is the position of the stock as at the close of business on 31st March. Similarly, closing say account payable, that is also closing, but we do not normally mention closing. Account payable is a ledger that keeps on growing or reducing depending on how you are making payment, how you are bringing goods on credit. So, if you bring fresh goods on credit, your account payable ledger goes up. If you make payment, this balance goes down. Likewise, this is a balance sheet item. Account receivable, all assets and liabilities are balance sheet item. All expenses are profit loss account item. Revenue is a profit loss account item. So, this distinction is very important, and this is one of the major part of confusion when you really want to start making a balance sheet. Nowadays there are accounting software. So, you might very well question as to what is the point of learning all of that. Is very important point, and most importantly you need to learn that whenever you will be trying to cut cost. So, you need to understand what are the revenue items, meaning what are variable in nature or fixed in nature that you can reduce, and then you can manage your cost so that your break even comes down, or say you can sell at a lower price, etc. We will discuss that in details. I mentioned the previous session that there are many kinds of profits, and every item has a meaning. Gross profit is equal to sales minus cost of goods sold, meaning your total sales in a year minus the cost of all those goods selling which you gain that sales. Sales also is referred to as revenue. So, there is no point of confusing between the two. Many people use it as revenue, many people use it as sales. So, sales may have different elements, like say other income. So, that is not direct sales. So, everything together actually is revenue, total money coming in, but sales primarily is sales of goods that you produce or that you buy to sell. The next item of profit is operating profit, that is estimated after you estimate gross profit, because operating profit is equal to gross profit minus operating expenses. We will explain it later. Profit before tax is operating profit minus interest expenses. Net profit is profit before tax and income tax paid on profit before tax. So, you deduct income tax from profit before tax to get net profit. Retained profit, net profit minus dividend. So, retained net profit is the profit that belongs to the founders. So, founders can claim all the money, whatever is the net profit, but then some portion of the money is retained in the business for future growth. So, you do not really take away all the money. What you do is you declare a dividend, meaning that suppose your profit is 1 lakh rupees. So, you may think that okay, let me take 40,000 rupees and let me keep 60,000 rupees back to the business, so that business grows with that money. So, whatever you pay to the founders, to the equity holders, that is termed as dividend, and after payment of dividend whatever is retained, that is called retained profit. In American language it is retained earning. In US, earning is used in lieu of profit. So, they do not call net profit, they say net earning. So, earning is confusing because in Indian context earnings means sometimes casually we refer to revenue or sales, but earning actually is profit. So, retained profit is nothing but retained earning, which is equal to retained profit net profit minus dividend. What is retained profit? Retained profit is transferred to the balance sheet after estimating profit loss account. Whatever is the net profit, you pay dividend, retained profit goes to the balance sheet and is added up with the reserves and surplus. EBITDA. EBITDA is very frequently used by analysts, particularly in equity research, equity analysis. In all those things, EBITDA is very frequently used. EBITDA means earning, earning means profit, profit before interest, before tax, before depreciation, before amortization. So, before all those items you estimate EBITDA. So, EBITDA indicates something. I am going to explain in the next slide perhaps. So, what is the formula? These are all profits. These are all profits. But then profit, why these profits? Let me explain it first. Because you want to compare two companies on the same standard, on the same scale. So, suppose you are comparing Tata Steel with say JSW Steel, whose performance is better. So, you may say that Tata Steel makes a profit of net profit of this, JSW makes a net profit of that. So, whichever is more, you may tend to say that that company is better. That is not an apple and apple comparison. Why? Because Tata Steel sales will be different compared to JSW sales. Even if you make a sales net profit percentage based on sales, that also may not give you a good idea, because JSW is a new company, Tata Steel is an old company. So, Tata Steel has high depreciation a low depreciation, whereas JSW may have high depreciation, because JSW plant is new. So, their depreciation is likely to be high, whereas Tata Steel, many of the machines are fully depreciated. So, their depreciation may or may not be high compared to JSW. Similarly, because JSW is a new company, so they might have borrowed more money, so their interest expense might be more than Tata Steel. So, operationally or say process wise, whether JSW is more efficient compared to Tata Steel or Tata Steel is more efficient to JSW, to make this comparison, you need to understand gross profit margin, you need to understand operating profit margin, you need to understand net profit margin, all of them, even EBITDA margin. So, EBITDA margin actually compares apple and apple, because it is taking away depreciation, amortization, tax, interest, all of that. It is just giving you some kind of operational performance. So, how the company, how operationally efficient is the company. So, suppose company A has operating profit margin of say 30%, whereas company B has 25%. So, A is operationally more efficient. Likewise, there may be many comparison on many contexts. That is why all those profits actually signify a lot of information. So, people are interested in those information, particularly if you are funding a company, you would like to know how the company, how profitable is the company, so as to be able to service the interest burden, what kind of interest burden they are servicing at this point of time, how they are going to perform moving forward after they raise new loans. So, for making a sensitivity analysis, say sensitivity analysis, we say raw material price variation. Suppose raw material prices vary by 1%, how the profit varies to a company, what percentage of profit is reduced by variation of 1% of raw material price, say increase of raw material price. So, all that actually is very important, and that is why we estimate margin rather than profit, because profit is a term that indicates the quantum of profit, but then it has some relation with the total sales also. So, we divide profit by sales into 100, we get the margin, so that we can make a comparison. So, gross profit margin is nothing but gross profit divided by sales multiplied by 100 and the like. Notice that the denominator is always sales. So, all the margins that are calculated, profit margin calculated based on sales. Sales is the common denominator. Why to estimate different profit, I have already explained, but you just remember that you want to make an apple to apple comparison, particularly the industry's background will be different. And remember, another thing is that you can only make a comparison between companies in the same domain, otherwise there is not much correlation and there is not much similarity. Suppose in steel industry, the gross profit margin might be say 30%, in software industry gross profit margin might be 65%. So, this comparison cannot be made across industries. For example, just to elaborate the point further, say what does gross profit signifies? Gross profit actually signifies, suppose a company is has higher gross profit margin. This means that the company is more efficient to convert raw material into finished goods. Maybe out of 1 ton of iron ore, perhaps a company manufacture 0.5 ton of iron ores, another company manufacture 0.4 ton of iron, another company perhaps manufacture 0.6 tons of iron. Why so? Because the iron content in the ore may be different, because their raw material itself is of different quality, or maybe their process itself, the blast furnace or electric arc furnace, whatever that is, maybe they are more capable, more efficient, or the people who are handling them are more intelligent, whatever that is. So, this process gives, this gross profit percentage gives an indication that this company is more efficient in converting raw material into finished goods, and perhaps demand more price, because maybe their quality is better. So, gross profit means sales minus cost of goods sold. Cost involve raw material cost, labor cost, utility cost like say power, fuel, etc. So, all these how efficiently you are able to manage, it depends on your gross profit margin. Suppose for some company the utility cost is very high, electricity cost is very high, or their system is such that it is consuming more energy, it is less energy efficient. So, their gross profit margin will be less. So, by looking at gross profit margin across a particular across companies in a particular industry, you will be able to identify which company in this industry is more efficient compared to other industries. Then again there are other factors, like we cannot go to that extent, but then if you have data, you can estimate what is the raw material cost percentage to sales. If you see that raw material cost percentage to sales is 20% for some company, 25% to another company. So, obviously, the other company is less efficient in using raw material, or the raw material quality is worse than the other company. Likewise, you may have a bargaining power to bargain low price for supply of raw material. Say iron ore, you have a captive mine, and your mine extracting the ore may be more efficient, cost effective than buying the ore from some other company or maybe importing. So, there lies some efficiency. So, in gross profit we capture all these information. So, let us move forward. Operating margin on the other hand is a combination of processing efficiency, like gross profit margin is already included there, and operating efficiency. Suppose your operating expenses are less, so your operating profit margin will be better, but then operating profit is estimated based on gross profit, because gross profit minus operating expense is operating profit. So, gross profit efficiency is already subsumed in operating profit, but then operating profit may not actually reflect the variation in gross profit margin, because operationally you may not be that efficient, they may not be exactly at par with the gross profit or the processing efficiency. However, it does not take into account the differentiation caused due to cost of financing across companies. Some company operating profit is estimated before allowing interest cost. So, operating profit percentage does not include interest cost. Therefore, if you are comparing two companies, one company has no interest payment, another company has high interest payment, operating profit margin may give different impression about their real performance moving forward, meaning in net profit percentage basis. That is why we have to estimate more and more profit. So, profit before tax is estimated by deducting interest expenses from operating profit. So, you have to estimate profit before tax and then estimate profit before tax margin to understand how the profitability varies across companies after payment of interest. That also is very important. Then comes net profit margin. So, let us estimate these profits for our sample company, the company that you have started in the hostel. So, first thing is we have to estimate cost of goods sold, because gross profit is nothing but sales minus cost of goods sold. So, let us see how this is estimated. So, if you remember that cost of goods sold is nothing but the goods that you consumed to achieve the sales by selling the goods, that is the cost of goods. So, it is the cost of the goods that you sold to achieve that sales. So, whatever you sold, you have to estimate what was the goods that you sold, and then you estimate what is the cost of that goods. So, how do you estimate that? See, at the beginning of the year, when you woke up early in the morning of 1st of April 2019, you peeped into your stock register or maybe your shop, and you saw there is some stock. So, on 31st March of 2018, before previous year, at the close of the business on 31st March of 2018, which is the starting of the business, you saw 5,000 rupees of stock, because you bought only 5,000 worth of stock. That becomes the opening stock of the next year, because you woke up early in the morning on 1st of April. So, opening stock is 5,000 rupees. Now, you bought 2,50,000 rupees worth of stock during the whole year, starting from 1st of April 2018 to 31st March 2019. So, during this whole year you bought a stock of 2,50,000 rupees. Now, at the end of the current year, that is 2018-19, starting from 1st of April 2018 to 31st March 2019, at the end of this year, that is as on 31st March 2019, your closing stock is 10,000 rupees, that you physically see. Nobody this information is available right before you, because you just count your stock and then take an inventory. So, you add them up, whatever the pens, paper, books and etc. Suppose you see that the sum total of them is 10,000, that is the closing stock. Now, you started the business with 5,000 rupees. So, that was available stock. Then you bought 2,50,000 rupees. So, 5,000 plus 2,50,000 is 2,55,000 rupees of stock was available, but you could not sell all the 2,55,000 rupees worth of stock, because you were left with 10,000 at the end of the year. So, 2,55,000 minus 10,000 is 2,44,000 rupees, that is the cost of goods that you sold. And then you deduct this from sales. It is the same slide repetition. So, you deduct that from sales to find out whatever is the gross profit. Gross profit is nothing but sales minus cost of goods sold. So, it is 2,55,000 rupees, because sales is 5 lakh minus 2,45,000 is 2,55,000 rupees. We have already talked about depreciation, we will be discussing that in detail. For the time being, furniture, total worth of furniture or book value of the furniture at the start of the business was 15,000 rupees, 1,500 rupees, and wear and tear or depletion of value during the year is on a ballpark basis. We allow some percentage, and hypothetically we have taken 10% as depreciation for this example. So, during the year, furniture fixture is presumed to deplete or reduce the value to the extent of 10% of its book value at the beginning of the business. So, at the beginning of the business, the book value was 1,500 rupees, we allow 10% as depreciation, which is 150 rupees, deduct that, we get 1,350 rupees. So, that is the book value or net of depreciation, net value of the furniture as on 31st March 2019. So, that is book value after allowing depreciation. So, this year the book value will be 1,350 rupees. Next year again we start with this book value, we depreciate it on 1,350, 10% of that becomes 135. So, 1,350 minus 135 will be the book value in the next year. Similarly, billing machine we bought for 10,000 rupees. So, depreciation rate is 10%, that means the billing machine is depleting value during the year due to operation, due to becoming old, due to wear and tear, to the extent of 10% of its value as at the beginning of the year. Beginning of the year value will be available in the previous year's balance sheet. So, previous year's balance sheet, the value was 10,000 rupees, that is the book value as in the previous year's balance sheet date, and we allow depreciation of 10%. So, 10% is 1,000 rupees, 10,000 minus 1,000 is 9,000. So, 9,000 rupees is the book value as on the date of closing of business of this year. That means, as on 31st March 2019, the book value of billing machine is 9,000 rupees. So, depreciation on furniture is 150, depreciation on billing machine is 1,150, sorry 1,000, total is 1,150 rupees. Now, we have estimated the gross profit. To estimate the operating expenses, you need the information on depreciation, and that is why we have discussed the depreciation before estimating operating profit. So, let us identify out of all the information which are available to us, which are part of operating expenses. See, sales we have already taken into account, sales is not an expense, it is just revenue. Purchase of material has already been taken into account in estimating gross profit and gross profit margin. So, salary is operating expense, rent is operating expense, closing stock is a balance sheet item. At the end of the business, whatever is the stock that remains unsold is the closing stock, that remains in balance sheet as closing inventory or closing stock. Transportation expense is a operating expense, telephone, electricity, trade license, depreciation, these are part of operating expense. Closing cash in hand will be available from your cash book. At the same time, you have to estimate it through in the process of cash flow statement. The end of cash flow statement, you will find net cash flow. You should add that to the cash balance in the previous year's balance sheet to get the cash balance as of the end of business of this year. That should come here as closing cash in hand, and that should match with your cash that is there. So, you should make a balance to avoid any kind of accounting anomaly. Accounts payable is a balance sheet item, that is a liability. Accounts receivable is an asset, that is also a balance sheet item. Assets, liabilities are balance sheet items. So, we pick up those items at one place and then estimate the operating expenses. Here operating expenses is 92,150 rupees, adding all of them up including depreciation. So, before now we have already seen that gross profit was 2,55,000 rupees. So, what is the gross profit margin? 2,55,000 divided by 5 lakh rupees is 51%. Then operating expenses was 93,500. So, operating profit margin is 93,500 divided by sales of 5 lakh, which is whatever is the percentage. Then interest, there is no interest because we have not paid any interest to any, because we do not have loan, we have a private loan from a friend and he is not interested in any interest. So, we are not paying any interest. So, operating profit becomes the same as profit before tax, because we are not paying any interest. Then income tax, normally it is 22% as per new rule, 17 to 22%, but for round figure we have taken as 30%. So, 30% of profit before tax is income tax. So, our income tax is 48,450. Deduct that from profit before tax, we get net profit, which is 1,13,050. Now, this money belongs to the founders, this whole money, that is 1,13,050. So, you started the business, this money belongs to you, you can take it home, you can spend the money, do whatever you like, but you may decide that okay, let me not eat all the profit because my business needs to grow. So, you plow back some of the profits back to the business, so that business grows. So, you decide that okay, let me take 50,000 rupees as dividend. So, this money goes out of the business to your personal account and 63,550 goes to the balance sheet and gets added up to the reserves and surplus. So, reserves and surplus keeps on adding this way, and here is a sample profit loss account statement. See, this belongs to Reliance Industries, and this is as on 31st March 2019. So, you can get this balance sheet using the link that is at the right hand corner. How to get this? You can directly get it from bseindia.com. You open this site bseindia.com, then you find a text box. It is mentioned as get quote. So, put Reliance Industries there or a part of the name, then a drop down menu will pop up and then you select Reliance Industries. Now, click that, then you find lot of information available on the landing page, but then you click on annual report. So, you click annual report, you will find a list of all annual reports in the history of the company, whatever reports they published. So, click on 2019 and scroll down to the pages where this profit loss account statement is available, and you find how these statements are made. They have more exhaustive items and ours is a very simplistic case. Now, let us prepare the balance sheet. So, this cash position will not be available unless you prepare the cash flow statement. I have populated it because I populated from an Excel sheet, but think for a moment that 45,645 is not available, it has to come from cash flow statement. At the beginning I mentioned that when you have the information and you are sitting to manually build the financial statements, you have to start with profit loss account, because one information from profit loss account goes to the balance sheet, and that is retained earning, retained profit. Without that information you cannot complete balance sheet statement. Without another information you cannot complete balance sheet is position of cash in hand and bank, that also will be available from cash flow statement. So, unless you complete cash flow statement, you will not be able to complete balance sheet, but then you cannot start making cash flow statement at the beginning, because many of the information in cash flow statement will be available in balance sheet. So, balance sheet and cash flow statements are to be made simultaneously. Prepare balance sheet as much as possible, then prepare cash flow statement, and then come back to balance sheet to populate the cash position, and then you have all the 3 statements. So, these information, most of the information in balance sheet are already available, it is already given, because these are available from general ledgers, and you have all the ledgers in front of you, like you have accounts receivable available, inventory, that is the closing stock available, then furniture fixture you have estimated from depreciation chart, then machinery after depreciation whatever is there is available, accounts payable available from general ledger, you do not have any short term bank loan, long term bank loan, or you have some other loans, you borrowed 4,000 rupees from your friend and you have repaid 2,000 rupees, might not have mentioned it, but you have repaid 2,000 rupees. So, the balance loan that is to be repaid is 2,000, which should remain in the balance sheet. Balance sheet shows as of this date, that is 31/3/2019, the loan outstanding is only 2,000, meaning you have to pay your friend another 2,000 rupees. The other items is owner's equity. First item is equity capital. You have invested 3,000 rupees at the beginning, if you remember, you brought 3,000 rupees, you borrowed 4,000 rupees to make 7,000 rupees to start this business. So, equity capital is still 3,000 rupees as long as you are not bringing in new money. Usually, equity capital normally does not reduce, because you normally do not take away money from equity unless you write it down. Then, as I said, whatever profit you plow back out of net profit after distribution of dividend, that comes here and added up with retained profit or reserves and surplus. So, retained profit was 63,995 this year, and previous year's balance was 0. So, 0 plus that is 63,000, total is 80,995. This is the total of the liability side, this is the total of asset side. You can very well see that they are exactly the same. And here is the balance sheet in one page. So, have a better view of that. Here is the balance sheet of Reliance Industries. You can pause and slightly enlarge the screen and see one part of the balance sheet, the other part of the balance sheet. Cash flow statement. Cash flow statement is a summary of company's cash inflow and cash outflow during a certain period. It may be a quarterly cash flow statement, half yearly cash flow statement, or annual cash flow statement. All cash flow items are grouped into three sections. So, one is cash flow happening from operating activities, cash flow happening out of investment activities, cash flow happening out of financing activities. So, these 3 activities, why they are separate? Because any analyst, particularly bankers, will be interested to know how the cash flow has happened, from what sources, from what operating cash flow. Usually or ideally, more cash flow should happen, or positive cash flow, cash inflow should happen out of operating activities, from where you are actually making profit. This is the reflection of business efficiency, whereas if you are financing your business through borrowing and cash flow becomes positive year after year through borrowing, it is actually ill health, you are creating problem for the company, and that is how many companies fell into debt trap by managing negative cash flow, by borrowing more money, making it positive, etc. Particularly founders and bankers are more interested to the cash flow from operating activities, and they have to really look into the growing nature of the cash flow, whether it is growing up or down, and how they are managing. And if they see that cash flow is going to become negative moving forward, they have to arrange money well in advance. There are other items in cash flow which is not really cash, but they are cash equivalent, like say receivables going up, accounts receivable. How accounts receivables go up? They go up by in the process of selling more on credit. You sell 1 lakh worth of finished goods to a party and he does not pay up, your receivable goes up by 1 lakh rupees. On the other side, you buy raw material of say 50,000 rupees from a person and you do not pay up. So, your accounts payable goes up, but then you get the raw material without making payment, that is a wonderful thing. You do business with that raw material, that means you are doing business on somebody else's money. So, that is a wonderful things to happen to any industry. Do not take it negatively, but most of the companies, they strive to get more and more credit, so that they can do business on other people's money, and they try to reduce receivables, so that the money flow is good, and the more efficient you are, the better you are. And any company with a strong brand, with a strong loyal customer base, are capable of managing both sides so efficiently, because the dealers, distributors would like to remain with you, and they will pay you money in advance to buy your product. At the same time, the suppliers will be more interested to supply you, because they know that you have a strong brand, your business is not likely to fail in a quick time. So, they want to remain associated with your company. Cash flow analysis has two methods. One is direct and another indirect. The direct methods includes all the expenses, all the revenue items. So, they are kind of a big, huge, long list of items leading up to the net cash flow, whereas indirect method starts with net profit. So, they do not talk about sales and other expenses, whatever is the net profit, this starts from there. So, operating cash flow statement includes net profit, depreciation, losses for sale of fixed asset or gains from sale of fixed asset. If there is, say, increase in current asset, if current asset goes up, that means cash has gone in to make those current asset, or decrease in current asset, meaning that cash has been released in the process of decreasing in current asset. Same is with liabilities. If current liability increases, that means you have received goods from somebody else, that means you have received money from somebody else, and decrease means you have paid him back. So, that is a negative cash flow. Negative and positive cash flow has this implication here. From investment activities, investment means you invest money in capital assets. So, if your capital asset goes up, that means some cash has been invested. So, that is a negative cash flow. If you make fresh investment, that is a negative cash flow. If you sell some capital asset, then money comes in, that is a positive cash flow. Do not confuse with the plus sign here. Any new asset that you procure is a negative cash flow. Any new investment you make, that is a negative cash flow, and the reverse, meaning that you sell some asset or you sell some investment, it is positive cash flow. Similarly, financing activity, suppose you borrow some money from bank, your loan amount goes up, that means there is a positive cash flow. Net investment in equity, suppose you bring in some money, you invest fresh amount of money. So, that is a positive cash flow, this sign is misnomer. On the other hand, suppose you pay some dividend, that money goes away from the company, that becomes a negative cash flow. Fresh equity investment is a positive cash flow, whereas this negative sign actually refers to the debt. Suppose you repay some debt. So, some money or some cash is used to repay, and that is why there is a negative cash flow when you repay some loan. And here is all the entries together. So, cash flow from operating activities, net profit, then plus depreciation. Depreciation is a positive cash flow, because it is a non-cash expense that you have allowed in the profit loss account, whereas the no cash expenses has been incurred. So, you add them back, minus increase in current asset. Current asset has gone up, that means it has consumed a lot of cash. So, that is to be minus, that is to be subtracted, plus increase in current liabilities. Our current liabilities has gone up, that means we have got more and more stock on credit. So, we are doing business from somebody on somebody else's money, so that is why it is plus. Cash flow from operating activities is A plus B minus C plus D, which is 1,07,000. Cash flow from investment activities. So, we purchase a new billing machine for 10,000 rupees. So, this is a negative cash flow, this 10,000 is negative. Cash flow from financing activities, we have two financing activities. One is we have repaid the loan for 2,000 rupees, is a negative cash flow. So, 2,000 should be negative. Similarly, we have paid dividend, money has gone out of the company. So, 50,000 rupees is negative. So, net cash flow from investment activity is negative 52,000. Net cash flow from net cash flow from investment is negative 10,000, net cash flow from financing is negative 52,000. So, net cash flow out of all the activities is E minus F minus H, because they are negative. So, total, and then you add total becomes 45,145. Now, look into the previous year's balance sheet and you will find that there was a cash of 500 rupees as at the close of business. Add them up, it becomes 45,645, and that is added to the balance sheet as cash balance. So, that is how the cash balance was this amount. So, this is the flow of information, how you estimate the cash balance. You start with net profit, you estimate the net profit, then adjust for non-cash expenses like depreciation, then estimate the net cash flow, cash inflow, outflow from change of current assets and liabilities like accounts receivable and accounts payable. Add and subtract the above to get cash flow from operating activities. Then cash flow from investment activities, change in fixed assets and investment. Cash flow from financing activities is nothing but changing long term liabilities and equity. Add them up, you get the net of the three activities. Eventually, you add them up with the previous year's balance to get the cash balance, and that you add to the that you take it to the balance sheet. There are very few references, but the book is wonderful. Horngrain, majority of the MBA courses follow this book for accounting purposes. Nothing about conclusions. Thank you so much.